Welcome to Alive's summer series, Summer Funds. In this exciting 4-week program, we're going to cover a myriad of topics from credit cards to owning a vehicle to paying for college, even charitable giving. Each session is pre-recorded, but you can ask any questions in the comments below. I will monitor and answer everything that I can. For those of you who attend all 4 courses, Alive has a special gift to kickstart your summer savings. A Sunkist certificate to showcase your financial prowess, and a $25 deposit into an Alive student checking account. Now, let's get started with credit cards. Today we're going to cover all the ins and outs of credit cards, including how they work, how to responsibly use them, how to use credit cards to build your credit, how to choose the right card, and then we'll cover any questions you may have. Before we go any further, allow me to introduce myself. I'm Hallie Hagist, Alive's certified financial counselor and a master practitioner of financial capability. My passion is providing financial education to help you make your financial dreams a reality. At this point, I've referenced Alive a few times. If you haven't heard of Alive Credit Union, we are a not-for-profit financial institution that has been serving the Jacksonville community for 70 years. Like a bank, credit unions offer checking, savings, and lending solutions, but in a not-for-profit cooperative business structure. Credit unions originated in Germany in 1845 to provide lending to people who would not have traditionally been given a loan at the time. Today, there are over 86,000 credit unions in 118 countries worldwide. Now that you know a little bit about Alive, let's dive into credit cards. So what are credit cards? Credit cards are a type of payment card issued by banks, credit unions, or other financial institutions. They allow you to borrow funds to make purchases up to a certain credit limit. You're required to repay the borrowed amount along with any interest on a monthly basis. If you don't pay the full amount, the remaining balance will accrue interest. Credit cards often offer benefits such as reward programs, where you can earn points or cash back on purchases. They also provide purchase protection, which safeguards you against fraud and defective goods. Additionally, using a credit card responsibly can help you build a positive credit history, which is important for things like getting a loan or a mortgage in the future. Credit plays a significant role in our financial lives, especially when it comes to major purchases like buying a home or a car. Having good credit can make it easier to qualify for loans and can lead to more favorable interest rates, ultimately saving you money in the long run. One of the key ways to build and maintain good credit is through responsible credit use. This means making timely payments on your debts and keeping your credit card balances low. These actions can help boost your credit score over time, which can open up more opportunities for you to access credit at better terms. For example, a higher credit score can help you qualify for a mortgage with a lower interest rate, which can save you thousands of dollars over the life of the loan. Similarly, having good credit can make it easier to finance a car at a lower interest rate, reducing the overall cost of the vehicle. By using credit responsibly and maintaining a good credit score, you can access credit at favorable rates and save money in the long term. In the world of credit cards, you'll see both secured and unsecured cards. Let's start with secured credit cards. These are a type of credit card that requires a security deposit, which serves as collateral for the credit limit. The credit limit is typically equal to the amount of the security deposit, which reduces the risk for the card issuer. Secured credit cards are often used by individuals with limited or damaged credit histories to build or rebuild their credit. On the other hand, we have unsecured credit cards. These are a type of credit card that does not require the cardholder to provide collateral or a security deposit. The credit limit for an unsecured credit card is determined by the card issuer based on the cardholder's creditworthiness, income, and other factors. Unsecured credit cards are the most common type of credit card and are widely used for everyday purchases. It's important to note that regardless of whether you have a secured or unsecured credit card, cardholders are required to make minimum monthly payments and are charged interest on any outstanding balances. Responsible use of either type of credit card can help you build a positive credit history and improve your credit score over time. Secured and unsecured credit cards serve different purposes and are suitable for different financial situations. Understanding the differences between the two can help you make informed decisions about which type of credit card is right for you. Not more than you can chew, it's important to understand how credit cards work. It's important you know your credit limit. A credit limit is the maximum amount a creditor is willing to loan to a borrower. Essentially, it puts a cap on how much the borrower can charge their account. Creditors create this limit based on several factors, such as creditworthiness, income, credit history, and other factors. Now, if you exceed your credit limit, you can accrue fees, penalties, and ultimately damage your credit score. Interest rates are another major factor in choosing and using a credit card. Interest is the cost of borrowing money expressed as a percentage of the total loan amount. You'll often see it listed as APR, annual percentage rate, which is the amount of interest applied to purchases made on the card. There are different kinds of rates, like there are different types of cards. Some rates are variable, meaning they can change over time when prime rates rise and fall, or if the creditor deems it necessary. Some rates are fixed, but more often than not, credit cards are variable. It's important to pay attention to interest rates, as higher interest rates result in higher borrowing costs and lead to significant debt if not managed correctly. Fees are charges imposed by credit card companies for various services or violations of the cardholder agreement. A common fee is an annual fee. While you may want to avoid cards with annual fees at first, those that have them are often outweighed by benefits that the company expects you to take advantage of each year. An example would be getting into a special club at the airport or advance access to your favorite artist concert tickets. Another fee is a late payment fee, which is easily avoidable. Just be sure to make the minimum payment by the due date every single time. Late and missed payments significantly affect your credit score, so beware. Now, let's put what we've learned into practice in a fun activity. On the next slide, I'm going to share a worksheet that's a credit card statement. Review the statement and then calculate the cost of making just the minimum payments using the following formulas. To calculate interest accrued, you will take the previous month's balance and multiply that by the monthly interest rate. Again, to calculate interest accrued, you'll take previous balance and multiply it by monthly interest rate. To find the monthly interest rate, you'll take the annual interest rate and divide it by 12. 12 months in a year means annual interest rate divided by 12. After you have those figures, you're going to calculate the new balance after making the minimum payment and applying interest. So the formula will be new balance equals previous balance minus the minimum payment plus interest accrued. Then we'll discuss your thoughts on your findings in the comment section below. Let's work through this together. To solve this problem, we'll continue calculating the minimum payment, interest accrued, and new balance for each month. The formula for interest accrued is interest accrued equals balance times APR divided by 12. In this case, the APR is 18%. So the monthly interest rate is 18% divided by 12. That's 1.5. So going forward, we can use the figure 1.5. We know the initial balance is $1,000. The minimum payment is either 2% of the balance or 20% $20, whichever is greater. In this case, $20 is greater than 2%. And the interest accrued for the first month is $15. That leaves the new balance at $995. Now, for the sake of this example, we're not going to be adding any additional charges on this card. Maybe in this scenario, we've seen that we've kind of racked up a balance on this card and we want to pay off this debt. So let's start with month number 2. Interest accrued equals 995 times 0.015, 1.5%, which is about $14.93. So under interest accrued, you can write $14.93. The minimum payment is going to be $995 times 0.2 or $20, and in this case, $20. So the new balance will be $995 plus 14.93 minus $20, resulting in $989.93. Month 3, our starting balance is now going to be $989.93. We haven't made much progress on paying this debt by paying the minimum, have we? So let's start by multiplying 0.015 by $989.93. Our new interest accrued right here is going to be 14.85. Our minimum payment would either be the $989.93 by 2% or $20, and in this case, $20 is larger, so it's going to be $20 again. Our new balance is going to be $989.93 plus $14.85, which is the interest accrued, minus our minimum payment of $20. Our new balance going into month 4 is going to be $984.78. Again, easy on your calculator, you can pull it out and work for month 4. So month 4 is going to be $984.78 times 1.5, which equals 14.77. That's interest accrued. Our payment is $20. The balance is going to be $984.78 plus $14.77 minus $20, making the new starting balance $979.55. Month 5 interest is going to be $979.55 times the 1.5%, which is going to give us an interest accrued of $14.69. The minimum payment again is $20, making our balance $979.55 plus $14.69 minus your minimum payment of $20, making our new balance $974.24. Okay, last month. We're going to take our starting balance, which at this point is now $974.24. Multiply that by 1.5%, and that will give you $14.61 of interest accrued this month. Make your minimum payment of $20, and your new balance is going to come out to $968.85. So, after 6 months of not using our credit card and only paying our minimum payment, we've paid the credit card company a total of $120, and our $1,000 balance is only down $31.15. So, was paying the minimum effective to our budget? Did we make any progress in our debt load? Let's keep this in mind as we discuss responsible credit use. Maintaining a healthy credit score is essential. Here are 3 key tips to help you. First, always pay your bills on time. This demonstrates financial responsibility and prevents late fees. Second, keep your utilization low. Aim to use less than 30% of your credit limit. This positively impacts your credit score. Third, avoid common credit card mistakes. Don't carry high balances and make sure to never miss a payment. By following those simple steps, you can maintain a strong and positive credit profile. Building and maintaining good credit requires responsibility. It takes a long time to build up your credit and a very short amount of time to tear it all down. So it's important to hone your credit building skills now. Here's how. Firstly, use credit responsibly. This means not overspending and keeping your credit utilization low, ideally below that 30% threshold. Secondly, monitor your credit regularly. Check for errors and signs of identity theft, and always know where you stand. Most importantly, always pay your bills on time. This demonstrates financial responsibility and significantly impacts your credit score. By being responsible, vigilant, and punctual with payments, you can build and maintain a strong credit profile. Choosing the right credit card is crucial for managing your finances effectively. Here are 6 key factors to consider. Annual fees. Some credit cards come with annual fees, which can range from minimal to significant amounts. Determine the benefits and rewards offered by the card justify the fee. For many, no-fee cards provide ample value without added cost. Interest rates. Look at the annual percentage rate, the APR, which indicates a cost of borrowing on the card. A lower APR is ideal if you plan to carry a balance, as it'll reduce the amount of interest that you have to pay over time. However, if you pay your balance in full each month, the APR may be less of a concern. Rewards programs. Many credit cards offer rewards, such as cashback, travel points, or discounts on purchases. Consider your spending habits and choose a card that offers rewards relevant to your lifestyle. For example, if you travel frequently, a card with travel rewards might be most beneficial. Credit limits. Your credit limit affects your purchasing power and credit utilization ratio, which impacts your credit score. Higher limits can be useful, but ensure that you can manage your spending to avoid debt. Just because it's there doesn't mean you need to spend it. Fees. Be aware of additional fees, such as late payment fees, balance transfer fees, foreign transaction fees. Understanding these fees can help you avoid unexpected charges and choose a card that aligns with your financial habits. Eligibility requirements. Credit card users have specific eligibility criteria, including credit score requirements. Ensure that you meet these requirements before applying to avoid unnecessary credit inquiries, which can temporarily lower your credit score. By carefully evaluating these factors, you can select a credit card that best suits your financial needs and goals. Remember, the right card can help you manage your expenses, build credit, and even earn rewards, but it's essential to choose wisely. Managing debt effectively is essential for maintaining financial health. Here are some key strategies to help you stay on top of debt. Start by creating a detailed budget to understand your income and expenses. Track every dollar you earn and spend to identify areas where you can cut back and allocate more towards debt repayment. A clear budget is the foundation of any successful debt management plan. Focus on paying off high-interest debt first while making minimum payments on other debts. This strategy, which is known as the avalanche method, reduces the amount of interest you pay over time and helps you limit debt quicker. You can also look into consolidating your debts with a low-interest personal loan or a balance transfer credit card. Debt consolidation simplifies your payments and can reduce your overall interest rate, making it easier to manage and pay off your debt. Don't hesitate to reach out to your creditors to negotiate lower interest rates or set up a more manageable payment plan. Many creditors are willing to work with you if they see that you're making an effort to pay down your debt. Commitment to your repayment plan is crucial. Consistently making payments, no matter how small, is key to reducing your debt. Set realistic goals and track your progress to stay motivated. To improve your financial health, avoid taking on new debt while you're paying off existing obligations. Focus on living within your means and saving for future expenses rather than relying on credit. Managing debt starts with creating a comprehensive budget to understand your financial situation. Prioritize high-interest debts, consider consolidating your debt, and communicate with creditors for better terms. Stay committed to your repayment plan and avoid taking on new debt to achieve financial stability. By following these steps, you and anybody you know can effectively manage your debt and improve your financial health over time. But remember, you don't have to get into this situation if you never get there to start with. So don't use your credit card for money that you don't have available. It's not extra money or free money. This is something that should be budgeted into your finances each month. All right, so we've covered some fantastic tips on choosing and managing credit cards, and now it's time to open the floor for any questions that you might have. Whether you have questions about the credit cards we discussed, need more information on how to choose the right card, or have any other inquiries related to today's presentation, please feel free to ask. No question is too big or too small. Just drop your thoughts in the comments below. If you think of any questions later or need further assistance, please don't hesitate to reach out. Our financial coaching team is here to help and support you. You can contact us at financialcoaching@alivecu.coop. Let's wrap up today's presentation by highlighting the fundamentals of credit cards that we covered today. We know the various types of credit cards, both secured and unsecured. We know how credit cards work and how to use them responsibly, as well as how to manage the debt that we take on. By making timely payments, keeping balances low, and avoiding unnecessary fees, you can establish and maintain a healthy credit score. Remember, credit cards can be a powerful financial tool when used responsibly. Thank you for being part of this series. Let's continue to make a splash in personal finance this summer when we meet next week. See you then.